Welcome to podcast episode 14 and video module number 5. Today we'll walk through the Vanguard 500 Index Fund. This is the last of the top 5 mutual funds found in 401k plans. In the first 4 episodes we touched upon American Fund's Growth Fund of America, Euro Pacific Growth Fund, the Davis New York Venture Fund, and Fidelity Contra Fund. This is your host, George Huss, and this is the 401k Owner's Manual. The 4 words that will kill your 401k investments every time? This time, it's different. Imagine you're Charles Henry Dow in the year 1885. Stock prices are easily manipulated by rumor, and financial news reporters have been bribed with stock tips or free stock to spin positive stories to manipulate stock prices. Publicly traded companies are not required to disclose any financial information to the general public and won't be for 50 years. To put the time period in perspective, Sitting Bull is killed, Vincent van Gogh dies, the Klondike Gold Rush begins, Teddy Roosevelt and the Rough Riders fight in Cuba, Mark Twain's Adventures of Huckleberry Finn is published, Ulysses S. Grant, 18th U.S. President, dies, Kodak patent trademark is registered, pieces of the Statue of Liberty arrive in New York City Harbor aboard a French freighter, the first appendectomy is performed, the first mass production of shoes begins, secret ballot system is introduced into the United States, and Louis Pasteur successfully tests an anti-rabies vaccine. As I understand it, Charles Dow believed company operations and financial performance drove stock value, but he knew any information floating in the public was suspect, and rumor was the fuel of choice to flame fear and greed among speculators. By all accounts, Dow was a man of integrity, a healthy skepticism and curiosity. He was a scientist, philosopher, brilliant economist, and well-respected financial writer, founder of the Wall Street Journal. Because of his observations, studies, and graphic records, the form of technical analysis known as point-and-figure charting was advanced. I can see him trying to figure out how to make sense of the stock market in his day, and I'd love to have seen his face when he first discovered what we now know as point-and-figure charting. I remember when I first saw this method in the early 1980s. This happened before the Microsoft IPO and before I got my hands on a desktop computer, the Apple IIe. I think I was surprised and perhaps a little angry. My education, training, and career had been founded in detailed financial analysis, and the idea that something as simple as charting supply and demand to anticipate stock prices just didn't sit well. At the time, I was doing financial analysis using 14-column paper spreadsheets and a mechanical pencil. If it was this easy, why didn't everybody use it? I came to believe the why wasn't important. I started charting by hand myself, and thousands of charts later, letting go of news and research and expert opinion was liberating. Accepting what is and focusing on truth with the logical, organized, systematic way to measure stock price movement has worked for over 130 years. No predicting, no forecasting, no media-driven frenzy. This time, it's not different, and the laws of supply and demand are timeless and irrefutable. And it's a pleasure to share it with you. So let's begin. So far, we've used 4 of the top 5 mutual funds found in 401k plans today to highlight how the method works. Today we're going to review the Vanguard 500 Index Fund, and the ticker symbol is VFINX. That's Victor, Foxtrot, India, November, X-ray. If you're listening in on the podcast and you need visual clues, take advantage of the 401k Owner's Manual YouTube channel. If reading works for you, the complete transcript will be out soon. Click like on our Facebook fan page and you'll get a notice when the transcript is ready. The instructions for pulling up the Vanguard 500 Index Fund can be found on stockcharts.com and can be found in either of the first 2 episodes. Before we get started, I'm going to run quickly through all 5 charts of the most popular funds in 401k plans today. Growth Fund of America, Euro Pacific Growth Fund, Davis New York Venture Fund, Fidelity Contra Fund, and the Vanguard 500 Index. Notice from 2003 through 2007, each of the funds demonstrated a series of higher highs and higher lows, a clear visual uptrend until we get to supply winning the battle in the beginning of 2008 through 2009, with each of the funds demonstrating a series of lower lows and lower highs. I promised I'd explain why this occurred. Buried deep in each prospectus, you'll discover a common disclosure item. It speaks to a restriction of the percentage of cash the mutual fund will be able to hold in the overall portfolio, the maximum being along the order of 10%. I don't know when or why this restriction came into play. I suspect it was born of some government regulation. The intent, I believe, was to protect investors from being overcharged. Now let me explain. Equity portfolio management fees typically range from 0.75% to 1.5%. Management fees for money market accounts, cash, typically run 0.15%. Somebody must have believed investors were able to consciously determine how much cash was appropriate and would get there by selling fund shares themselves. This is the disconnect between mutual funds implying they will do it all for you and the attitude that individual funds are but a tool to satisfy an asset allocation strategy. In other words, the mutual funds are not responsible for managing overall market risk. The unintended consequence was, in the wake of the so-called liquidity crisis in 2008, even if mutual fund portfolio managers wanted to avoid the freight train barreling down the tracks at 90 miles an hour, they were tied to the tracks. And so were you if you thought fund managers would do this for you. This is where the value of point and figure charting comes to the aid of investors. Clearly, someone should be watching the big picture. If the fund managers are not, and your broker is not, and your employer is not, and it's your money on the table, you owe it to yourself and your family to pick up these simple tools or find someone who will do it for you. Charts are easy to read. They're simple square box graphs. Down the far left and far right columns are numbers representing prices. Across the very bottom of the graph, you'll see numbers representing years. Inside the chart, you'll see columns that are filled with either X's, which are prices going up, or O's, which are prices going down. In some of the boxes, you'll see numbers 1 through 9, or capital letters A, B, or C. The numbers 1 through 9 represent the months January through September, and A, B, and C represent the months October, November, and December. They are there for reference only because these charts measure price movement, not time. Okay, let's get back to the Vanguard 500 Index Fund. You'll notice, just as we did for Fidelity Contra Fund, we adjusted the box size for the Vanguard 500 Index Fund. In this case, we're using a box size equal to $2 per box. We've done this for no other reason than to slow the chart down so we can see more clearly the significant price movement. Again, we're not interested in using this method to jump in and out of investments. We're looking for a way to manage investment risk. The way we do this is to identify levels of support and resistance and the overall trend in the price movement. To quote Bernard Baruch, noted financial economist who lived from 1870 to 1965, "Don't try to buy at the bottom and sell at the top. It can't be done except by liars." Okay, we took Fidelity Contra Fund through September 2011. So let's continue there. By October, the Vanguard 500 Index Fund chart broke through support at 104 and stopped at 102. Shifting one column to the right because of the 3-box reversal to 108, remember we're using a value of 2 points per box, so the price has to move 6 points to complete a 3-box reversal. Demand continues to drive the price 5 more boxes to 118. When the price reached 114, it was a new buy signal because of the violation of support at 104 was a sell signal. Sometimes buy and sell signals come quickly, and it's up to the investor to exercise personal judgment. One of the ways to do this is to set up mental stop-loss targets. I'm not an advocate of automatic stop losses. I prefer to have a choice. A stop loss is another risk management tool. The question to ask yourself is, how much of a loss am I willing to take? Successful investors always manage the downside risk because they know the key to wealth accumulation rests upon the avoidance of catastrophic losses. Again, this depends on where you bought the position. If you bought at 60, the move to 102 might not bother you. You may give it more time to see if it violates the last support at 94 and make a decision from there. Yet if you bought at 104 in March of 2010, you might want to sell some or all of the position at 102. It's a choice. It's always a choice if you're measuring price movement. If you're simply doing buy and hope, you would have no choice because you wouldn't know what to do. Make sense? If you've been following along the last 4 episodes, you can easily read the chart from October 2011 through October 2012. Despite the fact that 12 months have passed, the chart has only added 5 columns. All we see are higher lows and higher highs. It's a very orderly uptrend, even though we've had a tsunami in Japan, Muammar Gaddafi has been ousted and killed, Steve Jobs died, the presidential election in the U.S. and abroad, Spain accepts a $100 billion euro bailout deal, Greece is still fighting austerity plans, we had the Facebook IPO, Moody's downgrades 15 major banks in the UK, US, Canada, and Europe, Osama bin Laden is killed, Hurricane Sandy hits the northeast US and closed the New York Stock Exchange for 2 days, and the press is now promoting the worry of the fiscal cliff. Can you see how news is not important to price movement? It's the market's response to news, if any, which is important. Judging from the last 12 months on this chart, the market has been indifferent to the news. Nothing major has happened. How much time have you spent in the last 12 months consuming financial news media? Did it make any difference? Could you have been doing anything more productive or enjoyable with that time? If you'd been measuring market prices using the point and figure methodology, think of all the time and anxiety you could have saved. Oh, by the way, because the media is in the business of publishing content 24/7, and all of it is sold with drama and importance, isn't it like the boy who cried wolf? If all of it is important, none of it is more important than any of it to help you make better 401k investment choices. Food for thought. Turn off the media and start measuring. Okay, that's as far as we need to go with the Vanguard 500 Index Fund. Don't forget, you can download the transcript of this and past episodes by going to our Facebook fan page, the 401k Owner's Manual. You can like our fan page or sign up for free alerts on our website at yourwealthpreservationcenter.com. If you hope to learn something you didn't or would like to share something that surprised you, leave a comment on iTunes or below this YouTube video. If you'd like a personal invitation to an online free live workshop, jump over to my sister site at 401kealert.com. Thanks so much. Until next time, I'm George Huss, and this is the 401k Owner's Manual.